The overall economy isn't the only thing that can go into recession. The U.S. Treasury Department just admitted something shocking, that America is quietly slipping into a rental recession. No big press conference, no dramatic headlines, no cable news frenzy. Just a subtle acknowledgement buried in recent comments that the rental market is entering recessionary conditions and that years of distorted interest rate policy are now coming back to bite. And if what they're saying is true, renters, landlords, and investors are all about to feel the impact in a way we haven't seen in over a decade. Because this isn't just a story about people paying a little less rent. This is a story about rising vacancies, collapsing demand, panicked developers, and entire cities beginning to see rents fall month after month. And today, I'm going to walk you through the data, the cities already seeing a rent collapse, and when renters might want to act. Let's start with what the Treasury...
For months now, the narrative has been that the rental market is resilient, strong, healthy. You've probably heard it everywhere, from real estate analysts, from big multifamily developers, from the same people who said rents would only go up forever. But just a few days ago, the U.S. Treasury quietly slipped something into their latest economic commentary that basically blows that storyline apart. Their exact phrasing? The rental market is entering recessionary conditions. Not softening, not cooling. Recessionary conditions. That is language the Treasury almost never uses when referring to a single sector. And the fact that they used it for rentals, of all things, should be a massive wake-up call. And they didn't stop there. Officials pointed straight back to the Fed, essentially saying, hey, remember those ultra-low interest rates during the pandemic? The ones that triggered the biggest multifamily construction boom in modern American history? Yeah, that's part of the problem. Because all that cheap debt encouraged developers to build aggressively, borrowing billions under the assumption that rents would stay high and tenants would always be there to fill units. Then the Fed slammed on the brakes with the fastest rate hiking cycle in 40 years, and suddenly every new project in America was dealing with a financing shock nobody was prepared for. But here's the wild part. Despite all this, almost nobody in the real estate lobby wants to admit there's any rental weakness. They keep insisting demand is strong, even as vacancy rates quietly climb to decade highs. And most of the media? They're too busy covering home buyers to notice the renter story unfolding underneath. So when the Treasury steps in and uses the word recession, that's not just a comment. That's an alarm bell, a signal that the rental downturn is real, it's accelerating, and it's about to spread a lot faster than people think. The first unmistakable warning sign didn't come from a headline or a political speech. It showed up in the vacancy numbers. Quietly, almost politely, the U.S. rental market just hit its highest vacancy rate since the early 2010s. And if you know real estate cycles, that's the kind of milestone that whispers before it screams. National multifamily vacancies have been climbing month after month, and while we'll plug in the exact percentage later, the trend itself is the alarm bell. More empty units, more concessions, more landlords suddenly discovering the art of 2 months free. But here's the catch. This isn't happening everywhere at the same speed. The first cracks tend to appear where builders got a little enthusiastic. The Texas Sunbelt metros, for example, Austin, Dallas, Houston, cities where cranes became part of the skyline. Then you've got the Southeast boomtowns, places like Atlanta, Tampa, and Nashville, where developers acted like demand would never, ever slow down. And let's not ignore the Midwest markets that quietly racked up more supply than their population growth could justify. This surge didn't come out of nowhere. We're living through the tail end of one of the largest multifamily construction cycles in modern history, with more than 500,000 new units hitting the market in a very short window. Renters are doubling up, moving in with family, or simply refusing to pay top dollar for units they don't love. Wages didn't keep up with pandemic-era rent inflation, and now the math just doesn't work for millions of households. And this is where the recession first shows up. Not with a crash, not with drama, but silently. In the spreadsheets, in the inventory charts, in the tension between what landlords want to charge and what renters can actually afford. Months before anyone calls it a recession, the data is already telling the story. And right now, that story is getting louder.
Landlords aren't just adjusting rents right now, they're cutting them with a level of enthusiasm we haven't seen in over a decade. Year-over-year declines are now popping up across multiple states and major metros, and the pattern is unmistakable. Austin has slipped nearly 10% from its peak. Phoenix is down around 7%, and cities like Salt Lake, Atlanta, Tampa, and Jacksonville are registering steady declines that would have seemed unthinkable just 2 years ago. This is no longer a maybe trend. It's a map of softening rent curves spreading across the country like a slow-moving weather system. And the incentives, well, you know something's wrong when the luxury Class A buildings, the ones with the infinity pools, cold plunge spas, and suspiciously quiet rooftop lounges, suddenly become the most generous people in town. We're seeing 1 to 2 months of free rent, free parking, waived deposits, discounted storage units, and even short-term leases that used to be priced like a premium service but are now tossed in like a free mint on a hotel pillow. Landlords aren't doing this because they suddenly discovered compassion. They're doing it because they're desperate to keep occupancy numbers from dipping into the danger zone. This part of the cycle is critical to understand because rent cuts almost always show up before price cuts in the housing market. It's like real estate's version of foreshadowing. First, rents weaken. Then, landlords panic. Then, investors start worrying about valuations, and suddenly, the entire sector feels a lot more fragile. Right now, we're standing in that first stage, the early phase of a rental recession, where everything looks calm from the outside, but behind the scenes, the numbers are already breaking formation.
Developers right now are experiencing a very specific kind of panic, the kind that sets in when the math you built your entire project on suddenly stops working. Construction loans that were issued at 3 or 4% during the pandemic are now rolling over into rates 2 or 3 times higher, and the people holding those loans are staring at spreadsheets that look like crime scenes. Thousands of new multifamily buildings have been completed across the country, but many of them aren't even close to fully leased. And when your occupancy is weak, your net operating income drops. When your NOI drops, your debt service coverage ratio collapses. And when that collapses, well, lenders start asking uncomfortable questions. This is why we're seeing developers quietly selling properties at losses they swore would never happen. Others are handing the keys back to lenders, something that used to be a last resort embarrassment but is now turning into a survival strategy. And a growing number are delaying future projects indefinitely, not because demand for rentals has evaporated completely, but because the financing environment has become a brick wall. Even small rate cuts from the Fed aren't helping much, because cap rates are rising even faster. Insurance costs are exploding, maintenance is more expensive, and tenants simply won't pay the premium rents that were baked into the original business models. Here's the part that intensifies the pressure. The oversupply doesn't stop just because the market is weakening. All those projects approved in 2021, 2022, 2023, they continue to get delivered through 2026, meaning more units hitting a market that's already struggling to digest what's there. This is how a mild slowdown becomes something deeper. Not all at once, but in a slow, grinding, numbers don't add up kind of way that pushes seasoned developers into decisions they hoped they'd never have to make.
Investor distress is the part of this rental recession that almost no one wants to talk about because the losses aren't visible on a chart or a Zillow screenshot or a cable news headline. They're happening behind closed doors, inside private equity portfolios, syndication groups, and investor spreadsheets that were built on rent growth projections that never arrived. And now those projections aren't just off, they're completely broken. Private equity funds that bought huge apartment complexes in 2021 and 2022 are suddenly underwater because the rents they expected to collect are 5, 10, sometimes 15% lower than pro forma. That gap might sound small,
But when you're operating on thin margins and floating rate debt, it's the difference between profit and hemorrhaging cash. Syndication deals, the crowd-funded apartment investments that promised stable returns and passive income, are showing some of the earliest signs of distress. Investors are getting hit with capital calls, loans are slipping into default. Assets are being sold off not because the timing is right, but because the math leaves no other choice. And the early data confirms this is no longer anecdotal. Multifamily delinquency rates are rising faster than any other major commercial real estate class. Regional banks and small lenders, the backbone of apartment construction financing, are quietly cutting exposure, tightening credit, and refusing to refinance deals that would have been approved in minutes just a couple of years ago. This is the quiet phase of the crisis, the phase where the people who were supposed to be safest, the large operators, the big funds, the seasoned syndicators, are discovering that the rental recession isn't something happening to someone else. It's happening to them, right now, line by line, on their balance sheets.
If you zoom in on individual cities, the pattern becomes even clearer. This isn't a national softening. It's a full-on rent collapse beginning in specific metros that got hit with too much supply, too fast, at exactly the wrong time. And once again, it's happening quietly. In the leasing offices, in the incentive packages, and the occupancy reports, long before it reaches the nightly news. Austin is the poster child. The city that once bragged about unstoppable demand is now dealing with a tidal wave of new units hitting the market. Entire neighborhoods are stacked with freshly built complexes offering double-digit rent cuts just to get bodies in the door. Developers don't even bother pretending anymore. They know they overshot. The market knows they overshot. And renters are the ones benefiting from the correction. Phoenix is dealing with the same problem, just with more sunlight and even more empty Class A balconies. Thousands of new luxury units came online, expecting Californians to keep pouring in. But the migration slowed, rent fatigue kicked in, and now landlords are chasing a shrinking pool of tenants with discounts that would have been laughed at 3 years ago. Atlanta's situation is even more dramatic. Downtown rents are falling faster than almost anywhere in the Southeast, with some buildings reporting occupancy levels they haven't seen since the early 2010s. Tampa and St. Pete are right behind. Beautiful buildings, softening demand, and more new apartments scheduled to hit the market over the next 18 months than the region can reasonably absorb. Jacksonville, meanwhile, is quietly posting one of the fastest-growing vacancy rates in the entire country, a sign that the once explosive growth is finally hitting a wall. Salt Lake City is another surprise weak spot. A huge supply boom collided with a sudden slowdown in population growth, and the math unraveled almost overnight. Charlotte is covered in incentives, free months, waived fees, anything to keep units off the vacant list. Las Vegas is seeing investor defaults creep up as migration cools. Denver, which rode a decade of strong inflows, is now dealing with rising vacancies and rents that refuse to climb. And Houston, well, Houston always builds too much. But this time the oversupply on the east and north sides is so severe that even long-time landlords are admitting the market is getting harder to defend. These aren't isolated blips. They're early warning lights flashing on a map of cities where rent growth has not just slowed, it has reversed. And if these markets are leading indicators, the rest of the country is about to follow.
So here's the question everyone eventually asks. When should renters actually jump in? Because yes, a rental recession sounds dramatic, it sounds chaotic, but for renters, it's also an opportunity. And the key thing to understand is that we're still early in this cycle, not late. Historically, the biggest rent declines don't show up right when vacancies start rising. They tend to hit 12 to 24 months after that initial vacancy surge, once landlords finally accept that demand isn't bouncing back and their lenders stop believing the optimistic leasing forecasts. But here's the twist. Incentives peak before headline rents hit bottom. So the best deals often happen when the advertised rent still looks high, but the concessions are enormous. This is why renters need to watch for a few specific signs. When buildings start offering multiple free months, not one, but 2 or 3, that's a signal. When the same unit drops in price 2 or 3 times within 90 days, that's a signal. When big complexes start pushing move-in by Friday deals, like they're running a furniture liquidation sale, that's a signal. And if concessions come roaring back even in expensive coastal metros, that's not just a signal, that's the flashing neon sign that the window is open. Right now, all the early indicators say the true deal window will run from mid-2025 through the end of 2026. That's when supply peaks collide with expiring leases, weak demand, and desperate landlords. If you've been waiting for your chance to negotiate, to upgrade, or to finally stop overpaying, the rental recession is handing you leverage most renters haven't had in over a decade. Use it.
So at this point, it's hard to pretend this isn't happening. Treasury's quiet admission confirmed what the data has been whispering for months. The U.S. is entering a rental recession, and it's already reshaping cities, investors, and renters in real time. But this isn't something to fear. It's something to understand. Rents rising forever was never sustainable, and the correction we're watching now is the natural result of years of imbalance finally unwinding. For renters, this is a rare moment, a chance to negotiate, to upgrade, to actually have leverage again. For landlords and developers, it's a reminder that cycles still matter, even when everyone convinces themselves they don't. If you want me to break down your city or dig deeper into a specific market, let me know in the comments. And if you found this helpful, make sure to check out the next video. It'll put everything happening now into even clearer perspective. Every market cycle creates opportunities, and after a very long time, renters are finally getting theirs.